Hello friends, this is Dr. Vinayak Pagedar and today we meet to discuss the concept of depreciation under income tax. Now understand, when a businessman invests in assets, obviously the cost which is incurred has to be recovered, and therefore depreciation is a deduction which is allowed to the businessman under the Act. Now, when we discuss depreciation, we have to look into the methods of depreciation and how it is calculated under Section 32 of the Income Tax Act. So, the section for depreciation is Section 32. Now, what 32 basically says is there are certain conditions for allowing or getting the deduction for depreciation. That is, if you want the deduction for depreciation, then you have to satisfy certain conditions. There are two main conditions, and the first is the use of the asset for the purpose of the business. If the asset is not used for the business, like say it is used for personal purpose, then depreciation under Section 32 will not be allowed. But if the asset is used for the purpose of the business, then the depreciation will be allowed. The second is the ownership of the asset, that is, the assessee has to be the owner. So there are two broad conditions. The first is use and the second is the ownership. Now let us analyze use. Very clear, it has to be used for the purpose of business, then only it will be allowed. If not, then it will not be allowed. Let's take some examples. The personal house property in which I stay, my self-occupied property, can I get depreciation on that under Section 32? The answer is no, because it is not used for the purpose of the business. Then you will say, what about a let out property? Again, the answer is no, because the let out property is governed under Section 22 of the Income Tax Act, and the basis of charge of Section 22 tells you how to calculate and when to tax the income under the head income from house property. So we look at 22, 23, 24, and all this will give the computation. Now, this means that only business assets qualify for depreciation. The asset has to be used for the purpose of the business. Now, there will be a doubt in your mind. You will say, sir, what if the asset is partly used for business and partly for personal use? Then the answer, my friends, is that portion of depreciation which is connected to the business use will be allowed, and that depreciation which is connected to the personal use will be disallowed. In other words, you will get proportionate deduction for depreciation. Further doubts arise in your mind is, what if assets are kept on standby? Can we claim the depreciation? The answer is no, they have to be actively being used in the business. Only if there's actual use, you can get the depreciation. However, the nature of certain assets may be that they cannot be actively used and they are used only when a certain event takes place. In case of such assets, even on passive use, that is on a standby basis, the depreciation can be allowed. Like for example, a fire extinguisher. Will you actively keep using the fire extinguisher? Start a fire, use the fire extinguisher? That does not happen. Correct? So fire extinguishers are kept ready in event there is a fire, they are used. But on such assets, the depreciation has to be allowed even on a passive basis. So normal assets, active use, special assets like fire extinguishers, etc., the depreciation can also be allowed on a passive use. Now the second condition is ownership. The assessee has to be the owner. But if you analyze the provision properly, the assessee could be the registered owner of the asset. Fine. If the asset is in your name and you are using it in the business, obviously you will get the depreciation. But what if you are not the registered owner? Take for example, I purchase a motor car, a second-hand motor car. I start using it in my business, but the registration of that motor car under the Motor Vehicles Act on my name takes place in the next year. So from when do I get the depreciation? This year or next year? The answer is this year, because in such cases you have to give importance to use and you have to look whether a person exercises the rights of an owner. In such case, he becomes the deemed owner. A simple example would be even hire purchase assets. The ownership would be transferred when the last installment is paid. But since you are effectively exercising all the rights of the owner from day one, you get the depreciation even treating you as the deemed owner of the asset. Correct? So registration may not be a mandatory criterion. If you are the registered owner, fine. If not, do you exercise the rights of an owner? In that case, you would be treated like a deemed owner and you would get the depreciation. The third case is, what if you are the joint owner of an asset? If you are a co-owner of the asset, still you could get proportionate depreciation. So once again, a quick recap. Conditions, two conditions: use and ownership. Use for the purpose of business allowed, otherwise not allowed. If it's proportionately used, then proportionate depreciation deduction will be allowed. Ownership, you could be the registered owner, you could be the deemed owner, or you could be also the co-owner of the asset. Now my friends, let us say I use the asset, I purchase the asset in the current year and I use it for 2 months. Will I get the depreciation proportionately for 2 months? The answer is no. According to the Income Tax Act, if the asset is acquired and put to use, that means in the first year, in the year of the purchase, if you put the asset to use for 180 days or more, then you stand to get the full depreciation. For example, if the rate of depreciation is 15%, you'll get the entire 15%. But in the first year, that is the year of purchase, if you use the asset for less than 180 days, then you will get only half the normal depreciation. So use the asset for greater than or equal to 180 days in the first year, claim the full depreciation. If you use it for less than 180 days in such year, in that year you will get only half the depreciation. However, in the next year, even if I use the asset for 1 day, I stand to get the full depreciation. You'll say, sir, why? Because the words of the act are, if the asset is acquired and put to use, and that possibility arises only in the first year. In the next year, the asset cannot be acquired and put to use. It is just put to use, and therefore, even if you put to use for 1 day, the full depreciation is allowed. In simple words, the restriction of 180 days applies only in the first year and not in the future years. Now, I am getting a doubt here. What if I do not use the asset at all? The answer, my friend, is no use, no depreciation. So you have to actually use the asset to claim the depreciation. If you do not use the asset at all, then you cannot get the benefit of depreciation. Two points you have to remember here. In the year in which the asset is not put to use at all, no depreciation. And in the year in which the asset is sold, on that particular asset, you will not get the depreciation. In the year of sale of the asset, you don't get depreciation on the asset, and in the year in which you do not use the asset at all, you will not get the depreciation on that asset. Are we clear? Now, in case of an amalgamation, a demerger, a business reorganization, a succession, you should calculate the depreciation on the transferred assets as if no amalgamation has taken place. Step 1. Calculate the depreciation on the transferred assets as if no amalgamation, demerger, etc. has taken place. For example, A Limited and B Limited amalgamate. Some assets are transferred by A Limited to B Limited. The new company becomes AB Limited, for example. Now, the assets on which A Limited transfers to AB Limited, on that, you calculate the depreciation as usual, as if no amalgamation had taken place, and apportion this depreciation between the predecessor and the successor. In my example, apportion the depreciation between A Limited and AB Limited in the ratio of number of days for which the assets were actually used by them. Step 1. Calculate the depreciation as if there is no amalgamation, demerger, etc. Step 2. Apportion the depreciation between the predecessor and the successor in the ratio of number of days of actual use prior to the transfer and after the transfer. Now, what are the different methods of depreciation permissible under the Act? Number 1, the straight line method. Number 2, the written down value method. Only the straight line method and the written down value method are accepted by the Income Tax Act. In accountancy, we learn about various methods. You must have studied sinking fund. You must have studied the annuity method. Income tax does not permit these methods. We only accept the straight line method and the WDV method. My dear friends, straight line method is an optional method for power generating companies. Any company which is into power generation or power generation and distribution can opt for the straight line method. Correct? So, once it adopts this method, the change of method is not allowed. Let us say A Limited is an electricity manufacturing company. In the first year when it begins to generate power, generate electricity, it has to decide whether it wants to follow the straight line method or WDV method. If it decides WDV, it can go into WDV. If it decides straight line, it can go into straight line. But once it adopts that particular method, the change of method is not allowed. If it decides SLM, then later on it cannot go into WDV. Any other assessee besides the electricity companies has to mandatorily adopt the WDV method. Take for example me. When I file my returns, I have to go by the WDV method. I am not an electricity company, so I cannot go by straight line. I have to go by the WDV method. But an electricity company has the choice, and once it chooses, it cannot change the method. Let's take more examples. Let us say there's a company Like for example, think of any company. Let us say an investment company. Can the investment company go by straight line method? Answer is no. An educational institution, can it go by the straight line method? The answer is no. A doctor, can he follow the straight line method? The answer is no. All these business assessees or professional assessees have to mandatorily go by the WDV method, and my dear friends, any other methods are not allowed. Now, along with these methods, you have to look into a system. Along with these methods, you have to look into a system. And there are two main systems of depreciation. The electricity companies which have adopted SLM are allowed to depreciate assets on an individual basis. Each asset can be separately depreciated on the straight line method. But an assessee who does not follow SLM has to go by the block of assets system. And what exactly is a block of assets? There's a definition given under section 211 of the Income Tax Act. But in simple words, the block means a group of assets. And in this group, you only collect those assets which have the same type and the same depreciation rate. For example, a building with 10% rate of depreciation and furniture having 10% rate of depreciation cannot be grouped together. Why? Because the type is different. Even though the rate is same, the type is different. So for the purpose of block of assets, you have to group those assets which have the same type and the same depreciation rate. Correct? Now let us discuss something related to the block of assets system. Okay? Which are the assets eligible under the block? So what we are doing here is we are looking into the different types of blocks. As per the analysis of section 211, we have tangible assets and intangible assets. So when we block, we have to look into whether the assets are tangible or intangible. When you analyze the tangible category, there are three possibilities. The first block is building. The second, furniture and fittings. And the third is plant and machinery. Building, furniture and plant and machinery. For example, a shop would be classified as a building. Desk, chair, etc. would be furniture. What is plant and machinery? Now the definition of machinery is nowhere given under the Act. But as per section 43(1), if you analyze the definition, it says plant includes ships, vehicles, books, scientific apparatus, surgical equipments, but does not include tea bushes, livestock, building and furniture and fittings. This is given by 43(3). Plant includes ships, vehicles, books, scientific apparatus, surgical equipments, but does not include tea bushes, livestock, building and furniture and fittings. Now, I think of it simple. Any asset which is not building and furniture, provided it is tangible and depreciable, is plant and machinery. Motor car is plant and machinery. Air conditioner is plant and machinery. Computer is plant and machinery because it is tangible and does not fall into building and furniture category. So any tangible asset which is not building and not furniture is plant and machinery. Now many students say, what about livestock? Livestock is not a depreciable asset, so the question of depreciation does not arise. The asset has to be depreciable, it does not fall into building, does not fall into furniture, so it becomes plant and machinery. The interesting part is the intangible category. Now, intangible, KPCTLF, know-how, patents, copyrights, trademarks, license, franchise, or any other commercial or business right of a similar nature. So you got KPCTLF, know-how, patents, copyrights, trademarks, license, franchise, or any other business or commercial right of a similar nature. The first 6 KPCTLF you've understood, but you'll say, sir, what is any other business or commercial right of a similar nature? The answer is very, very simple. Various court cases have held that, look, an asset like goodwill, which is similar to know-how, patents, copyrights, trademarks, license, franchise, qualifies for depreciation under the intangible block. So in the tangible category, we have 3 blocks: building, furniture and fittings, and plant and machinery. But in the intangible category, we have 1 block consisting of so many assets. And as I told you, goodwill is eligible for depreciation as an intangible asset. So if you paid for goodwill, you purchased goodwill, you can claim the depreciation. Now, if you analyze Rule 5, the rates of depreciation are given block wise. So the key rates, the most important rates I'll be discussing, and please observe. First, building. Now in the building category, 3 parts. Temporary structures are to be depreciated at 40%. Temporary structures at 40%. Earlier, temporary structures used to be depreciated at 100%. But then an amendment was introduced saying that, look, no asset should be depreciated at more than 40%. Residential building, 5%. It's not personal building. Residential building, 5%. For example, companies have guest houses. That's a residential building, that goes at 5%. And any other building, like your office building, goes at 10%. So in building, temporary structures 40%, residential building 5%, any other building goes at 10%. Now what do you see? A table and few chairs, that is furniture. Furniture and fittings, my friends, goes at a flat rate of 10%. And now I should discuss plant and machinery, but all intangible assets put together are depreciated at 25%. I'm finishing it because a plant and machinery is a bit lengthy. So I'm finishing the small ones first. Building is clear. Furniture and fittings 10% and intangible assets at 25%. So your know-how, patent, copyright, trademark, license, franchise all put together goes at 25%. I hope this part is clear. Many students ask me, they say, sir, do we have to remember the rate of depreciation in the exam or will it be given in the question? It will not be given in the question. You have to remember there's no option. The only option is that there are no options. You have to remember the rates of depreciation. And now we go to the main part, and that is plant and machinery. Let us start with the motor vehicle. I've just put a motor car here. We all, when you become chartered accountants, you'll surely be thinking of buying a Mercedes or a BMW or something like that. So let's have the motor car first. Now, if the motor car is used in a hiring business, that is, if you have the business of running motor cars on hire, something like Ola, Uber, etc. This is the hiring business. Your Zoom car and all these. Now here the usual rate is 30%. Normally these motor cars which are used for the hiring business are depreciated at 30%. But in 1920 we have observed a big slump in the motor car industry. That means the motor car sellers like Maruti etc. are witnessing a drop in sales. Now there's obviously a pressure on their margins also, and they had approached the finance ministry for a reduction or the exemption from GST. Instead of giving them the exemption for GST, they were told that, look, the people who buy the motor cars from you and use it in their business, we'll give them some enhanced deduction for depreciation. That means the circular came out on 23rd of August 2019. So, if you purchased a motor car on or after 23rd of August 2019 up to the end of this year, that is 31st March 20, and you use it in hiring business, then instead of 30%, you get 15% more depreciation and the rate applicable will be 45%. The logic behind is to encourage you to purchase a motor car and get some additional deduction by way of depreciation. I hope this is clear. So the lucky ones are those people who have purchased the motor car on or after 23rd of August 2019 up to the end of this year, that is up to 31st March 20. I'm the lucky one here also. So, I don't use it in hiring business. I'm not a car driver or something like that. But now you'll come to know what I'm talking about. Now, normally the rate of depreciation for motor car for any other business, if the car is used in their business, was 15%. But the same way as this 15% increase was given to the people who use the car in the hiring business, similarly other businesses were also told that, look, if you're buying a car for the purpose of your business, then if it is purchased on or after 23rd of August, then we will give you 30% instead of 15%. Let me take an example. I purchased my motor car on 15th of September and I'm using it for the purpose of traveling in my business. Now, I'm not into hiring business. I'm a teacher, but for the purpose of traveling, rendering lectures, I use that motor car. Then in my case, I can claim the depreciation at the rate of 30%. Okay. What do you see? Ship. So ships are depreciated at the rate of 20%. What do you see? Oh, flying high. Aircrafts. Aircrafts go at 40%. Now, the assets which were earlier depreciated at 60%, 80% and 100% are also now depreciated at 40%. So the highest rate of depreciation is 40%. The only exception would be the motor car which is used in the hiring business and put to use on or after 23rd of August. They will get 45. The rest, all these assets now which you see, go at 40%. Okay. Glass containers, 40%. Books, the source of knowledge, but rarely touched. These go at 40%. The books, whether they are used for the purpose of your business, like a chartered accountant may purchase the income tax ready reckoner. That goes at 40%. Correct? Also, if you are running a library, lending libraries, then the books which you lend out, those books are also depreciated at 40%. In short, any books used in the business go at 40%. Okay. Your computers, computer related devices like UPS, printers, all these, even computer software goes at 40. Solar panels, energy saving devices, they also go at 40. And pollution control equipments also go at 40. So, it is very easy to remember these rates. Let's take a quick recap, a quick run through all these rates of depreciation and see what we can remember. Try to mind map. It is very, very simple. So we started with building. Here we go. Quick. Okay, the first was temporary structures. Temporary structures, earlier they were at 100, now they are at 40. Residential building 5%, others, any other building goes at 10%. Next, furniture and fittings, they go at 10%. Immediately I taken intangibles, they all go at 25%. KPCT, LF, goodwill, etc., everything at 25%. Now, motor car, two parts, hiring business and any other business. If you're into the hiring business and the motor car is acquired and put to use from 23rd August to the end of the year, anytime therein acquired and put to use, 45%. Usual rate is 30%. Any other business, like a doctor purchases a car on or after 23rd of August 2019 up to the end of the year, anytime in this period he has purchased the car and put it to use, then 30%. Usual rate for motor car was 15. So hiring business you got 45 and 30. Any other business you got 30 and 15. There you go. Ships 20%. Next, aircrafts at 40%. Clear? Then what did we have? You can literally think of the pictures. We had a glass container. Glass containers were at 40%. After that, books, yes, books were at 40%. Any books, remember, any books go at 40%. Okay, then what did we have? The computer software, computer related devices, all at 40%. The solar panels, that is the energy saving devices, at 40%, and the pollution control equipments also at 40%. Now my dear friends, any other plant and machinery. There are other rates also of plant and machinery, but we are discussing the most important ones. The general rate for plant and machinery is 15%. And what do you mean by the general rate? Like you see, a mobile phone would go at 15%. Air conditioners would go at 15%. This is the most common example of the general rate assets. So any plant and machinery which you don't see in your list would go at 15%. Now, this is where we've got to slow down a bit and understand how the depreciation is calculated in the block system. So, you will be grouping the assets having the same type and the same rate. For example, if it's building at 10%, all the buildings at 10% should come into one block. If there's a building 10% and a building of 5%, then there are two separate blocks. So, shall we start? We start with the opening WDV of the block. And to this opening WDV, we add the purchases. Now, loosely I've used the word purchases, but what we actually add is the actual cost of the assets. Let's take an example. I purchase a machinery related to this block for 1 lakh and the installation cost comes to 15,000. Then it is not Greek and Latin. You people know your accounts well. So the actual cost will be 1 lakh plus 15,000, which is 1,15,000. As we discussed, we group the assets into 180 days or more and less than 180 days. So we bifurcate 180 days or more assets during the year and less than 180 days assets during the year. Remember, the purchases which we add are the assets acquired in the block this year. Two parts, 180 days or more, second less than 180 days. So you get a total, and from this total minus the sale proceeds of any asset sold in the block. Minus the sale proceeds of any asset sold in the block. Now the question will give you the WDV of the sold asset. It will say an asset having a WDV of 35,000 was sold for 50,000 during the year. please do not consider the WDV of the sold assets. We only want the opening WDV of the block, and whenever an asset is sold, you directly subtract the sale proceeds of the asset. Now you'll say, why so? My logic is, the opening WDV is a cost. It is the reduced cost of your old assets which you are still using in the business. The purchases is also a cost. It is the current cost of your new assets. So when you add opening plus purchases, it gives you the total cost incurred. This is the cost of acquisition of your block. And now when you incur, you have to recover. If you sell your assets, you recover your cost, and that is why we subtract the sale proceeds of the assets sold. The words of the act are monies payable with respect to assets which are sold, discarded, demolished or destroyed. In simple words, I keep it at sale proceeds. Now, whatever remains is the WDV of the block. We call it the closing WDV. And my friends, on this closing WDV, you will calculate the depreciation. How to do it? Step 1. Separate the assets which are put to use for less than 180 days. And I'll tell you a simple trick how to recognize those assets. Any asset which is put to use in the year for less than 180 days, acquired and put to use for less than 180 days, on such asset you get only half the normal depreciation. And whatever WDV remains, on that you multiply it by the rate and you'll get the full depreciation. The total of these two will be your depreciation under section 32(1)(2), that is under the block system. 32(1)(1) is the SLM, 32(1)(2) is the WDV. Now whatever I have discussed, if you have any doubts, they'll be cleared when I take an example. But before the example, one very important point to understand. Let us say the closing WDV comes to 1 lakh. For example, the closing WDV which we calculated using this format comes to 1 lakh. And the depreciation under 32(1)(2) which we calculated comes to 15,000. Then what will be the opening WDV of the block for the next year? This year I'll get a depreciation of 15,000. But the next year's opening WDV will be the current year's closing WDV minus the current year's depreciation. Correct? Once again, let's look at it, how we go about it. We start with the opening WDV, add the purchases, the actual cost of assets acquired and put to use in the block. We separate the 180 days or more use and the less than 180 days use. To this, we subtract the sale proceeds from this. Why? Because it's a recovery of cost. We get the closing WDV. The closing WDV is bifurcated into two parts, less than 180 days and the balance. On the less than 180 days amount, you'll get only half the normal depreciation. On the balance WDV, you'll get the full depreciation. Add both, you'll get the depreciation under section 32(1)(2). Clear? Now let's proceed. Opening WDV for the next year will be closing WDV for the current year minus the current PY's depreciation. And now let's go with an example. The example is, I've got a block of plant and machinery. I'm taking a 15% depreciation block. The block of plant and machinery carrying depreciation at the rate of 15%. The opening WDV of this block on 1/4 of the PY was 5 lakhs. Correct? We purchased some assets in this year and we started using them in our business. First was a second hand machine which we acquired and started using from 1st November 2019, 1st November of the PY. Now remember, any asset which is acquired and put to use from 5th October 2019, this is a leap year, so from 5th October 2019 will be a less than 180 days asset. And at your end, you can count. If you have acquired and started using the asset from 5th of October 2019, then it will come to 179 days use. So any asset which is acquired and put to use till the 4th of October 2019 is 180 days or more. From the 5th of October, if you've acquired and put the asset to use in this year, then it is less than 180 days. Now what is the date which you see? 1st November of the PY. So it is on or after the 5th of October. This asset is a less than 180 days use asset. And on this, you'll only get half the normal depreciation. I hope we are clear. Okay. The next is air conditioner. We acquired an air conditioner and started using it in our business from 15th of December of the PY, 15th December 2019. Again, it is on or after 5th of October, after the 5th of October. So the 6 lakhs also qualifies for half the normal depreciation, less than 180 days use. And now, the third asset, you tell me. We purchased a motor car on 1st May of the PY and started using it in our business. We purchased it for 5 lakhs. Is this a less than 180 days asset? The answer is no, because it is put to use before 5th of October and therefore it is a 180 days or more asset. Clear? There we are. In the example, an old machine in the block whose WDV was 1,75,000 was sold for 1 lakh on 31st January 2020. 31st January of the PY, you sold an old machine. Now, in accounting terms, what you do in accounts is you calculate the profit on sale of such an asset. My dear friends, we are dealing in a block of asset system and therefore we do not give importance to the profit or loss on the individual asset. So here, if you say the profit on sale of the asset is 75,000, that is as per accounts. Income tax just considers the sale price. And how much is the sale price here? It is 1 lakh. So we'll consider 1 lakh in our calculation and ignore the 1,75,000. The profit or loss and the WDV of the individual asset is to be ignored. So, what does our question say? Our question says, compute depreciation under section 32(1)(2). Now, how do we go about it? The opening WDV of the block of assets on the 1st of April of the year. Now, what was the opening WDV? Correct. It is 5 lakhs. So, here we go. Now, collect the assets of 180 days or more and collect those assets of less than 180 days. Like for example, my second hand machine and the air conditioner, both are plant and machinery, both get depreciated at 15% and both are put to use for less than 180 days. So 6 plus 1, 7 lakhs will be written in that less than 180 days slot. The motor car, as we discussed, was 180 days or more. So you got 5 lakhs of assets of 180 days or more and you got 7 lakhs of assets of less than 180 days. Total acquisition and put to use comes to 5 plus 7, which is 12 lakhs. The cost of acquisition of your block is 5 plus 12, which is 17 lakhs. And now, my friends, how much will you write in the sale proceeds? Correct. The sale price of the asset, 1 lakh. So 17 minus 1, the closing WDV of the block is 16 lakhs. Now what will you do? Correct. Bifurcate it into two parts. Less than 180 days. The less than 180 days assets. How much? There you see whatever is in red, the 7 lakhs. And the balance WDV will be 16 minus 7. That will be 9 lakhs. Correct? So here we go. On the 7 lakhs, you will get 15% into half. How much does that come to? You do a calculation. How much does that come to? 52,500. And on the balance 9 lakhs, at 15%, 1,35,000. Add both. This is your depreciation under section 32(1)(2), 1,87,500. I hope you've understood this. If you have any queries, you can WhatsApp it to me and I'll be more than happy to solve your queries. Till then, so long, be good and stay safe. Bye-bye.